right, good morning, everybody. TGIF, huh? So today we got non-farm payrolls, kind of the biggest thing on the block. We have an opportunity for a trade that I really like. It's called a gap fill play. It's a liquidity gap. It's not a regular gap. So newer traders don't really see it until you point it out to them. When we think about the traditional gap, price closed at one location and opened somewhere else, left a gap behind. This is different. It's what we call a liquidity gap. The idea is we're looking for price to go back to where the candle started. I've got some examples that I always show whenever talking about liquidity gaps. These can happen on any time frame, and they can happen at any time. The nice thing about economic events like non-farm payrolls is we know when it could happen. It's almost like Back to the Future when they needed a lightning strike. They needed to know exactly when there was going to be a lightning strike. Well, it's kind of the same thing here. We're looking for a gap, a liquidity gap candle, and we know when there could be one because it's the 8:30 non-farm payrolls. Even if you don't want to trade this strategy, just knowing that the strategy exists will offer you some assistance going forward, just from the idea that, if I can help you from not going in the direction of the gap, and taking that losing trade, then that'd be a good thing, right? I'll take that as a win. So here's the idea. And this one was CPI. So it's not just non-farm payrolls. 8:30 print. There's really no wick down here. It didn't try to go in the other direction. It went up, digested a little bit, continued to go up, put in a top, came down and got the gap closed around 11 o'clock. A little early, but by 11. Or another example here to the downside, no real wick going in the other direction. Closed in the lower part of the candle, put in a base, got the gap closed a little after 11. Or another example here, no real wick going in the other direction, closed in the upper end, got the gap closed around 10:30, a little early, but got it done. So you get the idea, right? This is all examples of where we had a very large candle, what I call a liquidity gap, and then we came back down and we got that gap closed. Now it can give you a big candle and not get closed, right? I added an example here where we had one. This was CPI. We had the perfect candle. Everything looked great, but it did not come back down and close the gap. So just because it works a lot of the time doesn't mean that it works all of the time. Today, we could also end up with a candle that looks a lot like this. And this is what we don't want. There's not much of a gap if price closes really close to where it opened. We don't really have any work to do at that point. It doesn't mean that this candle is worthless, though, because we can measure the entire candle and project that candle out just like they teach in all the textbooks. 50% of that candle and then 100% of that candle. We were hitting about 50% across that high. It's what we were stalling against as a resistance. We just wasn't able to get beyond it. So even if we do end up with one of these really big candles, it's not a waste. We'll use it. Another example of what we do not want to see for a gap close play. Again, it's opening and closing really close together, big wicks on each side. This is not helpful. It's not what we want. And again, another one. So when I show people the liquidity gap, I always like to show examples of what we don't want and a reminder that it doesn't have to do it, right? Here's an example where we never got it closed. So just keep that in mind. This morning at 8:30, we're going to have that opportunity. It's very likely we're going to get a big candle. So we'll either get a liquidity gap candle or a really big candle with wicks on each side. Markets are mostly green this morning. Even the Mag 7 that started out kind of negative has already started to work its way back into the positive. Japan down the most, and there was a little bit of news on Japan with the tariffs this morning. They're chipping teeth about the auto tariffs. NASDAQ basically flat, S&P up a quarter, the Dow a little higher than that, and small caps up the most at more than 0.75%. Now this is the odd thing this morning, right? What we've been seeing is small caps dragging its feet, lagging behind, really not keeping up at all. And we've been seeing tech dominate. This morning, it's the other way around. Tech is dragging its feet, really not participating, and small caps are running and doing all the work. I know the jobs data is the biggest one on the table today, but this is a significant change here at 10 a.m. These factory orders, while 8:30 is going to get a lot of our attention today, if we miss this big on these factory orders at 10 a.m., we could see some fireworks later in the morning. So keep that one in mind, right? That's a really big change. If we go from 0.6 to 4.3, markets might like it. They might throw a fit. Yeah, same thing here. Not the exact same numbers, but pretty darn close. Previous, not even 0.5%. And the consensus estimate is running at 4.5. Wonder if they'll announce a revision too on that 0.6. Anyways, either way, keep your eye on it at 10 o'clock. If we come in and we miss that number, could get fun. All right, we are maintaining the move through the 10-week. Been holding above it now since Wednesday afternoon. We're above the 3-day, the 10, the 20. Volatility trigger, zero gamma, put wall. The only thing we've got left is the call wall, 58.24. And I'm pretty sure that call wall is rolled up. Just check yesterday's. Yeah, it was 56.24 yesterday. Now it's 58.24. So they rolled it up 200 points. Generally speaking, that's a bullish behavior to see them roll up the call wall. Yeah, I like it. So it doesn't mean that we're going to go up. It is just one more bullish checkpoint. If you're looking for, signals that that they're getting scared and nervous, that they're tightening their belt, allocating out, this is a signal that they're giving us some headroom, giving the market room to move up. Maybe they'll address that change in the call wall when we get the founder's note this morning, but we haven't got that yet. Overnight volume at 78. It's fine. It's in line. It's really light compared to what we've seen recently, but all of this week has been under 100,000, which is getting us back towards the norm. The concern is that it's only this light because Japan's been off all week, right? That they had a holiday. which gave them a short week. And it's one of their bigger holidays. So where a lot of other people, once the holiday was officially done, they just didn't go into work for the week. The analogy would be, say for us, something like Thanksgiving week, right? Officially, it's only one day, but most of us just take the whole week of Thanksgiving off. So we should see this volume pick back up again next week. All right, we got a market maker move this morning, which is not much of a surprise. Totally understand the idea that they're hedging in front of this event. CPI, PPI, non-farm payrolls, we can get really big moves from those situations. And so while they are always hedged, they oftentimes will add an additional hedge, like short-term, just some binary assistance, right? The idea here is, this isn't my opinion. I'm not guessing or assuming that they're hedging. We know for a fact that they're hedging. If you don't have Thinkorswim with the label up here that says market maker move, as long as you have options on the futures, your broker should provide the implied volatility average, which is over here on the side. Right, so we'll just scrunch all this together. This is the 0-day for today. The number is 28.6, and the next series out is 20.5. So this front expiration is higher than this expiration. And because of that, we get a market maker move right there. If you go to schwab.com, they've got articles written about the market maker move that they rewrote from TD Ameritrade. TD Ameritrade had a lot of articles on the market maker move. None of them discuss futures, but it does talk about what it is, how it's calculated, and that's why I know about it, right? So this number on the side here moves up or down because of the trading activity in the out of the money options, right? Now, it's a formula that's secret. They don't give us all the ingredients of what is in that formula. We know it is time, and it is the implied volatility within the options strike itself for all of the out of the money options. And it has a square root formula in it. Now, what else it has, we don't know. But the options get traded out of the money. The more frequently they're traded, the size of the trades themselves, it'll change that number. That's why the average is there, right? So all of the out of the money options, when they go in and start hedging in the morning, they're worried about a situation or an event, we can see that hedging. 2,800 here, 2,300 here, another 1,100 there. So they're coming in here and they're putting on big trades this morning, out of the money options, and that trading activity jacked up the implied volatility average and put it into a market maker move. So you can see it even if you don't have Thinkorswim, as long as you have options data. We are closer to the upper line than the lower line, but not by much, and I wouldn't give that any credence. The one thing that's going to take precedent first today is the economic data. So pivot points like yesterday's high or low, Globex high or low, none of those hold any weight against an economic data point. That happens first and foremost. Once we're done with that, then we can reassess the situation, lay out pivot points, and work from there. So we need to get this data point. It's a pretty simple setup for today. We need the big candle. We'll evaluate that big candle when we get it, and whether or not it's really wicky on each side, or if it's like the pictures showed where we got no wick on one side and we close far away on the other side, then we can measure that candle out and evaluate whether we're going to get a gap close or not. that one candle should take precedence even in relation to something like yesterday's low and yesterday's high. That CPI or non-farm payroll candle is going to be first. Then we'll deal with these levels, unless the candle gets us outside of that level on either side. All right. Today's floor pivot is higher than yesterday's. That's bullish. Price opened underneath it. That's bearish. Those two things sort of cancel each other out. We've already hit the pivot for today, so we don't have an MDP for today, but we did earn one yesterday, and that gets applied today. If we had another one today, we'd apply it on Monday. I don't use that strategy for trading, but it is useful in analysis. Not mine. By the way, I didn't develop it. So if you want to know more about missed daily pivots, you can just check Google or YouTube and type in missed daily pivots. You should find it. It's useful context and depth of purpose for using floor pivots. At the very least, if you don't want to trade with that strategy, just knowing it will help you use the pivots better. It would be useful at this point to have a what if kind of scenario, right? What if things get pretty bad today? What does bad look like? The weekly floor pivot at 5,400 is not out of line on a day like this. It's not really all that far away either, less than 250 points. We can easily hit that, right? We're talking about an ADR in a single direction. And the same thing, if we look at the other direction, that would put us at 58 and a half, call it 59, right? Which would be pretty much the 200 period daily moving average at this point. That is what extreme would look like, a 250 point move in either direction, your plus or minus. We don't have any reason to expect that it's going to be that nasty today. Just kind of hitting on the what if it does get bad, or what if it does get really good. One of the things that I'm concerned about is that 10 a.m. time frame. That was an outlier number that has a lot of hopium tied into it. As you would expect for the week, since we've been holding up here, we're building out another distribution, but we haven't moved the point of control up yet. If we do give up 5,600, then 5,550's got some structure that we've built out. And if we overshoot that, we've got 5,500 with last week's point of control. $10-day, 30-minute volume profile with TPO. As we've discussed earlier this week, we're not going to see these candles get hit for at least a week. So the point of control isn't going to move unless we build out a new spot. Now, we put 18 hours or so in this new spot. We're building out the candles, but there's a lot of work to do. Other than that, we don't even have a classic shape. We don't have anything to really lean on. We're just building out the profile at this higher level around the value area high, no less. And it's a race against which one's going to win first. Are we going to put in enough work here to move the profile up? Or are we going to stay in this zone, not really building out enough volume, and then we start wiping these candles out and it gets moved up there anyways. Worst case scenario is we fall back down, break the point of control, retest the value area low, and we start building out this 5,300 area down here. No new VPOC from yesterday. We still have one overhead, 5,700, and we got one below us, 55.35, 55.32 cog line, the way I would look at it. And since it's Friday, we have a little bit of a preview of what next week's range is going to look like. Now, this isn't set in stone. It won't lock into place until tonight after the market closes. But we can get a feel for what the market is pricing in, look at next week's range and compare it with this week's range. They're about the same. Now, I'm not getting all nerded out on this, breaking out the calculator and, zooming in and trying to get it to the tick perfect. It's not that important. If it was really far off, you'd be able to see it from an eyeball, right? You don't have to get the calipers on it. Next week, volatility looks a lot like this week's volatility. This week, we had QRA, non-farm payrolls. What do we got next week? FOMC should be close enough to FOMC for that would be next week, right? Yep, 5 days to the next meeting, May 7th. That would be next week. So I guess it kind of highlights how important or how impactful QRA is with non-farm payrolls, because next week's range is as big as this week's was. On the other hand, FOMC is volatility suppressing. Yeah, I know. It doesn't sound right when I say it, right? It's all right. The first time I heard someone else say that, I thought they must be cracked in the head, because FOMC is a very violent situation. How is that volatility suppressing? But for the first 2 days, a lot of times we don't do anything because it's Monday and Tuesday in front of the Wednesday FOMC, and the markets just kind of drift sideways and chop sideways. We just really don't do anything because we're in a suppressed volatility environment. So while it doesn't sound right the first time you hear it, think it through. FOMC is a suppression of volatility for Monday and Tuesday. We're still holding above the 10-day, and we're not quite into that extreme area yet. If we get back above 2.5, then we'd have to worry about that extreme, but we can see that we're on the fade back down. So we're moving away from the critical zone or the danger zone. We don't want to turn this around and start going back up. If we can just hold the line and not really go anywhere, the 10 will come to us. That'll reduce the size of this gap. And or we could turn and fall back towards the 10-day, and of course that would close the gap. But it's not extreme, it's not overheated. We haven't gone too far too fast, and it doesn't owe us anything. For the 10-week, we're back in the positive for the first time in quite a while. Nowhere even close to being in the extreme, less than 1% above the 10-week. It's a really good place to start. At this point, we could fall right back down through it. Probably isn't anything there to help us out. We would need to spend more time and get farther away from that 10-week before we could expect it to be any sort of supportive function. But we're not extreme, and just the transition from being below it to above it wasn't very much, as opposed to some of these, where we were very deep below and then very high above in a single shot. That's a lot more extreme. This was really not much of a transition at all. So the same thing, not overextended. We haven't gone too far too fast. Nothing's broke. It doesn't owe us anything. We need the data this morning before we do anything else. But we got a lot of positive stuff. So when we look at what's not positive, the VIX is down. That's really about it. Everything else is up to some degree. And we use 0.5% because we're doing this so early in the morning. China's up. And if we look at China, the top two is China. Then we got semiconductors, then two more for China. Then junior gold miners, gold again, miners, chips again. Kind of get the idea, right? And that's all of these, all of that is just chips, precious metals, and China. Now we get through all of that, and then we get some uranium, nat gas. And look, you don't want a rally on nat gas, right? You don't want that. Then we got cloud computing. We'll have to check that one. Cloud computing could be a little sneaky. If it moved after hours, but it didn't move this morning, it'll still show the after hours value. And it doesn't usually get a lot of pre-market movement. So that after hours is what lingers. And yeah, there's nothing here this morning. So we'll ignore that being up. Finance, that's one that we need if we're going to rally. Healthcare, building materials, industrials, biotechnology. Not really what we're looking for here, other than finance and chips. So we don't have the pieces we need for a good, strong rally day. Crude is also down. All right, finance is one of the three that we have, and chips kind of fits into tech, generically speaking, but at this point, we don't have the sectors that we would want to see for a big rally day, and we don't have the market breadth that we would want to see for a big rally day. So we got to get the data in this morning, see what the numbers show. 48% of the S&P is up 0.5%. That's a good number, to be fair. That's some good breadth. And 45% of the NASDAQ is up at least 0.5%. And again, that's a really good number. It's just not enough by itself. So after we get the 8:30 data, take a look at the sectors that are moving. We want those 3 risk-on sectors that we always focus on. XLF, XLK, and XLY. Those are the risk-on sectors. Now you can get some help from energy, building materials, industrials, shown, no problem. But if we're looking for a capital flow changes to the play, then we want to see money flowing out of the defense and into the offense. And it's a weird morning because the Russell is leading, right? So keep your eye on those short covering plays. That would certainly fuel a fire. All right, well, it's giving it back. I'll, I will post in the chat. I'll do some digging around. I don't think it's a small caps recovery day. I think they're just in play for a little bit, but it'll get shaken out by the time we get into the open. Let's get the data. Keep your eye on 10 o'clock. Yeah, it's a big gap between what we had and what they're hoping for. And hope is a really bad trade strategy. So if it misses and we don't get that 4.5 or whatever it is they're aiming for, markets might throw a fit on that. Be careful, be safe, have a good week. I'll see y'all on Monday.